I want to talk more about the economy, inflation, and interest rates. Joining us right now, Jim Bullard is the former St. Louis Fed president. He's now Purdue University's business school dean. Good morning to you. We've been having a bit of a raging debate about just how much inflation is actually in this economy right now and what the Fed should or shouldn't do about it.
Yeah, inflation's, I think, on a path to continue to decline. It looks like year over year, core PCE will decline when it's announced. And so I think the committee's in very good shape here. There's a little bit of risk that inflation will turn around and go higher. I'm only putting 20% on that right now. Markets are a little bit concerned about that, and that's weighing on things a little bit. But the baseline case, I think, is intact. I don't think the committee has to do anything probably before June here.
Okay, but that's if we just sort of stay steady here. I think part of the question is if the tariff situation gets put into place, what happens then? And whether even just the prospects of those tariffs, even today, and we haven't seen the data yet, is already putting some kind of inflationary pressure into the economy.
Yeah, I mean, tariffs don't cause inflation. They'd be a tax, and that would be a one-time increase in the price level. Usually the committee would look through something like that. But you hit the nail on the head about how people should think about tariffs. The issue is who wants to make very large investments around the world when you don't know what the rules are going to be? And the answer to that is no one wants to do that. So it's the expectations of turmoil in this world. You don't know, you're playing a game and you don't know what the rules of the game are. That interferes with global investment, and that effect occurs immediately, even before tariffs necessarily are actually implemented. And it's that scenario played out in 2018, 2019, and ultimately the Fed reacted to that, and I was on the committee, by lowering the policy rate in the teeth of the trade war. So I think that's the main thing that markets should be concerned about here, not one-time changes in the price level.
I mean, one of the things that I've been fascinated by, there was obviously a huge expectation that once President Trump won in November, there'd be a massive wave of mergers and acquisitions. One of the things that has not happened, in fact, January was one of the lowest months in some time in terms of deal making, in part, I think, and you tell me, a function of folks saying, we don't know what the tariff situation is going to look like.
Yeah, I think when you upset global expectations, then people always want to pull back. A merger would be a huge decision for various firms that are involved, and semiconductors, I guess, is one that's been being looked at or split there. So, but that kind of decision is hard to make if you're not sure what the rules are going to be.
Right. Hey, Jim, while I have you here, we spoke to Michael Barr yesterday, who, of course, is stepping down from the supervisory role, in part to prevent, a larger battle inside the Fed or around the Fed in terms of its independence. I was curious about your personal view of his decision to do that. Was that the right decision? And who do you think will replace him, if at all?
Yeah, I think he was in a difficult position, but now the precedent has been set that when the new president comes in, the vice chair for supervision steps down and allows the new president to name a new person. I would prefer that was a little bit, not speaking specifically to President Trump here, but I'd prefer, as a matter of how we run the democracy, that would be a little bit away from the actual incoming administration, because now it makes it just the same as, let's say, other financial regulatory areas where the new president comes in, you say, well, this guy won the election, so now you're going to turn over all these jobs. I think to have continuity, you would spread that out a little bit across the president's term.
The other thing I was going to ask you about, and I don't know if you saw it, Jay Powell was asked about it last week, this idea of debanking. This idea that banks have been debanking customers and clients that don't have particular political views, it sounds like, to the left. And I mention this because President Trump specifically called out Brian Moynihan and Jamie Dimon directly when he was in Davos about this. Do you believe that there is genuine debanking in America over political ideology?
Yeah, I've seen some of that. Sometimes there is a fragmented regulatory environment in the U.S., and some of the regulators do things like say, "Well, hey, I don't want you banking this gun firm, or I don't want you banking this cannabis firm." That's another one that's tough. So I think this has been a hot issue, especially for community bankers. And you know, I don't think you want to enforce rules through the regulatory channel. You want, if you don't like a particular industry, then you should make law about that.
Jim, but here's the question. My understanding of it is that, you know, to the extent that regulators have told banks either not to bank folks in the gun industry or in the cannabis industry, which obviously I think there was a question just about the legality of the cannabis industry to begin with.
Oil industry.
Maybe oil. I think that was less so. I was going to go crypto, where I was going to. But underneath it, at least what the regulators would say, and some of the bankers would say, is it's about whether this industry is as good a credit as others. Meaning, are they actually going to pay the money back, and therefore, what kind of risk it creates in the system. And if, in fact, the default rates are higher in the gun industry or if in the crypto industry.
That was the excuse with oil. It has no future.
I don't know. Come on. These guys are in the business of, you know, evaluating credit risk. And sure, some things are more risky. A restaurant maybe is more risky, and something else, the car dealer down the street is, I don't know, maybe less risky. That's what they got to do every day, and charge them the right price and you know, for the risk. So I don't think the regulator should be coming in and saying, "Hey, that one looks bad. That other one looks good." That sounds like political interference.